Hello, friends. Today we are looking at Texas Instruments, ticker symbol TXN. They just reported this past week earnings. We're going to be taking a look at the earnings. We're going to be looking at the past 10 years of financials. We're going to determine if it's a good stock to own and what fair value would it be and to pay for today. And also, I'm gonna summarize an opinion from another YouTuber that I respect and see what you guys think. I will encourage you to go and take a look at what he is thinking, and I'll let you know whether I am going to be investing in Texas Instruments. I do not hold any shares right now, and I will highly encourage you to remember that this is just for educational purposes, just a YouTuber talking about stocks in the internet. You should not invest based on my advice or my opinion. It's not advice, it's just my opinion. I am not a financial advisor. So with that said, Texas Instrument is a company that makes chips, and this is a company that a lot of dividend investors like. Why? Because part of what management likes to focus on is free cash flow, which is very interesting. Dividend growth. It has been growing for the past 20 years at a CAGR of $20%, and they have been buying back shares since 2004. That would be a 47% reduction. So they are very good at paying dividends and growing the dividends and as you can see here, dividends have been growing for about 16% in the last 10 years and at 13% in the 5 years. And when it comes to shares, they buy an average of about 1.3 to 1.8% of their shares yearly. So that is part of the reason why a lot of people like Texas Instruments. However, last report created a little bit of people got a little bit afraid of owning Texas Instruments. It decreased 14% from last year, as you can see, the revenue, and the operating profit went down 29%. Net income 26% down, and earnings per share went down 25%. Big part of that has to do with capital expenditures. It has gone up almost 57%. And when I was listening and trying to understand from Dividend data, this is a YouTuber that I listen to. I encourage you to go and look at his explanation. What he was talking about is look at the free cash flow. It was very consistent in the past quarters. Very consistent, very consistent, very consistent. Then it goes down and it goes negative and it goes up a little bit again. And if you see capital expenditures, there was, once in a while, there was a big one here, and then they started to grow it, and continues to grow. And what he was explaining is that part of the problem is that free cash flow is not able to cover the dividends, which in the long term, that can create a problem because they're going to have to take it out of their cash on hand. I think he explains that they have about $8 to $9 billion in cash of hand. Not a problem if this is short term. But as he explains later is that as he was listening to the call, they are expecting to continue to spend a lot of money on building some different manufacturing facilities all the way to 2026, sorry, not 16. So that is something, that is a reason why sometimes whenever we look back at these numbers, like this 10-year financials. It's good to do that, but we also need to understand that just because a company has been good, that doesn't mean that it has a bright future. We always need to look back, but also look forward at what management is trying to do. So right now, revenue, as you can see here, has been growing pretty nice, consistent, about 6 to 4%, which is not a big deal. But the companies can grow slow their revenue, but make a big difference when it comes to the earnings per share. And as you can see, Texas Instrument, it's one of those companies that has been growing their earnings per share. And part of the way that they do that, they have been growing for the past 10 years at about a 15%. The past 5 years, about a 6.5%. It's been slowing down. Part of the way that they're able to do that is, of course, by buying back shares. That helps a little bit when it comes to the earnings. Also, just reducing cost and taking care of the margins. If you see at the margin over here, the average margin, the profit margin is 38%, which is pretty good. Free cash flow is been going up, but just like I mentioned before, in the past couple of quarters, it has tumbled down from above 6% in the past 5 years, all the way to $1.81. That is a huge drop, and we can see that reflected on the stock. That year to date, the last year, it's been at it has fumbled about 8%. So that's not that bad. But the question is it going to continue to have these problems? Would you pay in your calculations thinking the free cash flow is going to be somewhere around 6? Well, what if for the next 4 or 5 years it's going to be around 2 to 2.5? Well, that's going to change everything. Free cash flow earnings, it has been at 38%. But I have an asterisk here, because if you look at free cash flow, it went down. It had been in the 20s, the margins, and then suddenly it went down to 10%, which is really low for this type of company. The book value has been growing a little bit. It's been in the 6%, 14% in the last 5 years. Return of equity and asset and return of invested capital are pretty high, and they continue to be high, not as high as normally. Normally has been in the 60s, but this past year's down to 45% in the return of equity, almost 10% down on return of assets and return of invested capital. We talked about dividend, how it's been growing, but also the debt has been growing. Right now, with the average free cash flow, of course, we're talking about $6 to $5, and in the tops above $6. Of course, they can pay this $12 share long-term debt for about in 2 years. But if we were to think that now they're going to be producing about $2, well, now we're talking about 6 years to pay that long-term debt if they don't continue to increase the debt. And just like the YouTuber that I was talking about is that there is the only, if they continue to do that and pay the amount of dividends that they are doing, right, because they have no free cash flow, they're going to either have to go into debt to continue to do the capital expenditures and pay dividends and buy stocks back, or they're going to have to deplete their cash reserves, which is about at 8 $8 billion. So they just spent $3 billion in 6 months. So this is 3, 4, 5. So they only have like about a year and a half in reserves, though. That's kind of crazy. So it has okay numbers. This is something that is super concerning. Analysts are saying that it for the next 5 years is going to grow at 10%. Honestly, guys, for me, once again, this is just my opinion. This is not advice. I'm just going to listen to dividend data, and just like he is going to stay away for a year and a half, see what happens with the capital expenses. I'm going to do the same thing. However, if you disagree, you can put it down in the comments. You can tell me whether I am wrong and he's wrong, and what are some of the things that you see different from us. The other thing that I noticed is in the report, it said that the automobile growth will continue and industrial weakness broaden. Well, this is before the big car companies were with the whole union stuff, were shut down, and they were not able to produce as much. So I'm wondering if they're going to take a hit next quarter when it comes to that area, and how much I think that we're going to be entering a recession in the next year and a half, and I think that is going to slow down also the demand for chips. So I personally am going to start looking more into defensive companies, the companies that have a great moat. So those are the things that I'm going to be focusing on. But if you want to take a risk on this company, or you think that you're good to go, the historical valuation, it gives us a price between $134 to $144. Notice that the free cash flow, it's pretty low, just because the trailing 12 months there. With the payback time using the 10% of the for free cash flow, it will be a $65, and if you use the average, it will be $200. I do not believe that the free cash flow is going to be growing at a 10%. I think that, well, let's say even if it does, then this is probably going to be more the numbers for the next 5 years of the payback time. So when it comes to the discounted earnings per valuation, you are looking at somewhere around $108 to $100. But remember, the earnings are going to start getting hit with all the capital, with all the issues with the I can't think today. Sorry, the recession. Capital, the 10 cap, the earnings. Owner's earning valuation, as you can see here, the capital expense is going to make a huge difference on this valuation. 1.1 billion, less than a billion, 2.5 billion, 3 billion. Now we're at 5 billion. So that's going to start eating out. That's why the trailing 12 months, this is supposed to say something different. It's at 70%, and the average is 120. If you put it all together, a fair value, it will be somewhere between 120 and 135. And right now the price is at 140. Analysts think that it's going to go up to 180. So if you were to take the highest number, 135, and you wanted to put a 20% margin of safety, you will be looking at entering somewhere around the 110 to the $100 per share. If you wanted to go with a deep discount at 50%. So you're looking somewhere around the $60s to $70. Anyway, those are my opinions when it comes to Texas Instruments. Please don't forget to go and watch the complete video of dividend data, and don't forget to subscribe, to leave me a comment, and if there is any stock that you would like to see, just let me know. Have a nice one.